The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN, and I'm going to focus the first part of the show today on the foreign exchange markets, particularly the U.S. dollar. I posted into Tiger TV the long-term weekly chart on the dollar, and you can see the lower tops that are occurring, and we are at a 786 retracement at that particular time right now. But if we post the daily chart, you'll be able to see a micro view of what's happened over the past 2 years, because we bottomed last April of 2011, and now we're coming into March, April of 2013, and we're making a beautiful head and shoulders pattern. It's extremely symmetrical from the time from January when we made our high, and then we expanded up to the 1.618 level into July of 2012. Then we came down to a 50% retracement, and now we're completing a Gartley pattern at this 83 level. And if you've listened to the show any time in the past 4 or 5 days or weeks, you'll know that we've been waiting for this 83 level to be completed, because it does complete a head and shoulders pattern. That doesn't mean it's not going to go higher. It's just saying that this pattern is complete. Everything is set up. What's interesting is that today's high was a perfect 786. It hit it right to the exact penny in the U.S. dollar index. So I think we have to respect that. And this market for the U.S. dollar, has been constantly up since February. So we've been up 6 weeks, basically an uninterrupted move, into this level right here. So the 83 level in the U.S. dollar index, should offer some, really, really strong resistance if we're looking, at the currencies. And I watch the currencies all the time, so it's very important, to take a look at that. I'm going to put the ETF up for the U.S. dollar index, because it's called the UDN. This is the short dollar index, and you'll see that it also is setting it exactly at the 61% retracement. So we're at some type of a major point here. I don't think there's any question about. Well, I don't think there's any question about it. The market might not think so, but all the numbers are and the patterns are set up, to see if this market's getting ready to turn, whereas where we get a move in the euro or the yen or something like that. Well, when you look at the U.S. dollar, the main thing that you need to look at, of course, is the yen. And excuse me, what am I talking about? It's the euro, and the reason for that is the euro is 53% of the market for the currencies. And that's the main thing that we've had 3. I'll put this up in here. You'll have to excuse me, folks. I had a life-changing experience yesterday that I hope no one ever has to go through. I've had to go through it 3 or 4 times in my life, but our little grandson had a life-threatening situation where he had to be taken to the hospital with an ambulance, and he's only 20 months old, and we didn't know what was happening with him for about 4 or 5 hours. And as you know, with grandparents, that's total hell. He's doing better. He's doing fine. I think he's going to have a complete recovery, but they still don't know what's wrong with him. But anyway, and I haven't been sleeping, so that's why. That's why if I make many mistakes today, you'll have to bear with me. But I did post into the Tiger Den is the euro going back on the weekly basis to 2008, and it has some beautiful patterns through here. And we're setting exactly at the 786 of the low that we made back in November, and that was that major low that we had when we had the solar eclipse and new moon on November the 14th. And so we're making a 786 retracement at that level, at the 129 level. So what I'm looking for is I'm looking for a place to, to see a counter trend rally here occur, in the euro. I still, long term, I'm still bearish the euro, but, this thing has been down for 6 weeks in a row, and it's incredibly oversold. And so this is an area, and, as a trader, this is what you want to do. You want to try to, get into an area where you don't have to risk very much. The old adage, you want to buy them when they're crying and sell them when they're yelling, and that's what we're trying to do now. The whole world is, bullish the dollar right here, and they should be because it's made its target up here at the 83 level, and we've been watching that for a long time. It's a perfect head and shoulders pattern. It might not, it might fail, but right now, if you look at the currencies one at a time, and that's what we're going to try to do here this morning, they're forming some really interesting patterns at some key levels. So we should pay, close attention to that. This is a trading opportunity, is what it is. This should not be construed as to say that, okay, the euro is going to rally here. That means that stocks are going to rally. That correlation left a long time ago, folks. And the same thing with the bonds. That left a long time ago also. This is just about money moving. That's all it is, nothing more, nothing less in the Forex markets. But we are at a very, very critical level at this level. And, we're also at a critical level in stocks that we've talked about, for several weeks, of course. And the New York Stock Exchange Index has never exceeded the 786 retracement. And neither has the NASDAQ. So these patterns are still, the same way that I'm looking at them. But we have a potential game changer here with the U.S. dollar getting ready to change, because it's got a lot of things in its favor as far as technically that would make it change. And I think the next big one that we looked at the euro, of course, and now we need to look at the U.S. dollar the dollar versus the Japanese yen, because we have looked at that one for a very, very long time. And we've been watching this 786 level up at the 96 level on the long-term weekly basis, and it shows, some really strong symmetry. It shows the 48-week cycle has been there, and we are halfway through the 48-week cycle. We're 1 week past halfway, and the price objective that we've been waiting for up here at the 786 has finally been met. And the whole world knows that the Japanese yen is the currency to jump on now, because it's all over Bloomberg. When it was down around 75, 76, making higher bottoms, the whole world couldn't look at it at all. But now everybody wants to get on it. I'm very bullish this for a long time frame. But what we really need to do is we really need to get a ABCD pattern to form, hopefully down around the 88 level. That's about $7,000 from where it is now. But don't forget, we went from 75 to 95. That's over $20,000 in a matter of 6.5 months. So when you have moves like that, you'll get some counter trend moves that are usually pretty wicked. And the Forex markets follow the numbers that we look at in the Fibonacci sequence incredibly well. They follow the patterns incredibly well. We see them in the euro, and we see them in the yen, the Australian dollar. All of these follow the numbers. That's why the Forex is so much fun to trade, is because it's pure money, and they don't have to worry about some of the things that you have to worry about with stocks, like earnings and dividends and things like that. It's just pure money, and it's real easy to trade, and it's thousands of times bigger than the stock market, which is really good. But we are at a very critical level here. In order for this to fail, we would need the dollar index to close strongly above the 83.50 level, and the yen would have to close above the 97.50 level, and the euro would have to close below the 128.50 level. Then I would say this cycle pattern that we have of the head and shoulders is not going to work. But as of right now, it has done what it's supposed to be doing, and it should hold it up, relatively well, if in fact that's the case. So these are trading opportunities that we're watching, and that's what we look at here. So this is the important thing, is to keep in mind that this is what we're looking at with the U.S. dollar. We are at a really, really critical level in the U.S. dollar. There's no question about it. It's got so many things going for it that it's just truly amazing. Now, what I'd like to do is just to show you, the way to when you're trading these things. If you will, I'll give me a second here. You'll see the 61% retracement. I'm just going to do a 15-minute chart on the Japanese yen versus the U.S. dollar that we were just talking about, and you'll see that the pattern that we just had not more than a couple hours ago was a perfect 61% retracement back with a Gartley pattern with the ABCD coming in at the 96.22 level, and so far it's backed off about $350, heading to the downside. So that's the best way to enter when you're trading Forex, is to go to the daily chart and then go down to your 15-minute or 30-minute chart and try to find the pattern and the ratio that allows you to enter without risking very much. And we're looking for that AB equals CD pattern that we know so well, and then we're watching for the 61% retracement and to see how that works. And then those are the really important things that I think are for entering and not risking very much, because it's all about risk control, folks. It's not about how much money you're going to make. You got to think about how much money you're going to lose, and you'll be far, far better off if you're protecting, what your capital is. That's why, professional football teams, the really great teams, have great defenses, because they try not to let the other team score, and that's a very important thing. Because if you've got bullets in this game, you will be successful. I'll have to get off I got a minute here, but one of the worst groups of traders that you'll ever find in the commodity markets, stock markets, Forex markets, are doctors. And believe me, I've trained a lot of people over the 35 years, and believe me, hands down, doctors are by far the most difficult group to trade. And the reason why is they think they're smarter than everybody else, and because they make a lot of money, they can throw money at the markets, and they think that doesn't make any difference, and they don't think they have to follow the rules like everybody else. And believe me, that ain't the way the game is played, folks. We have to follow rules just like any other business. This is what this is. It's the business of making money, not being right or wrong. You have to follow rules. You have to have patience. And doctors have patience, but they don't have the kind of patience necessary for trading. But boy, they are tough to train, believe me. There's been a few that have done incredibly well, but basically, as a group, not too much. Got to take a break. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and I want to shift from the U.S. dollar and foreign currency over to the gold market because we've had over the past several weeks, we've had some pretty wild gyrations in gold. We did come down last Friday to that real strong support at the 1560 level, and then last night we rallied up exactly to the 61% retracement of the high from the 26th of February that came in at the 1600 level, and we backed off about $15 an ounce from that point, but we do have a strong support still coming in around that 1570 in the gold market. It still looks like it has a pretty good chance of holding that level, and it's a place where when it hit that 61% retracement level and backed off, and then went back and tested it again today in gold at 1600, it was telling you that it wasn't ready. It wasn't really ready to go anywhere, and so that's why we're having this little bit of a sell-off. The gold silver indexes, we'll double check those when we come back from the break, but they still look like they're holding up incredibly well, and that's the main thing that we want to look at. Now we need to take a look at the silver market because it's picking up a little steam here, and it's acting a lot more bullish than the gold is. We're having so many higher bottoms now in the silver market. I think the one that we had today is our fifth straight higher bottom that we've had in silver. And if you've listened to the program at all, and Basil and Steve, they all preach the same thing, is that when you have these higher bottoms in the markets, it's telling you that the people are coming in and willing to buy at these higher levels, and that determines the trend. Because if you have higher bottoms, you're in an uptrend. If you have higher tops, you're in an uptrend. If you have lower tops, you're in a downtrend. If you have lower bottoms, you're in a downtrend. And so we are still, for the past 3.5 weeks, we've been in a pretty strong uptrend in the silver market, and with these higher bottoms, that's a very good sign. It's important that we stay above $28 per ounce in the silver, but it still is holding up, incredibly well. The gold is holding up also, but it's under more pressure, more selling pressure than the silver is. So this is the first time that this has happened in quite a while, where silver is actually, held up a lot better than the gold. Usually, silver is the wicked stepsister, and goes crazy one way or another. But this time it's holding up, much better than the gold market. That could be a positive thing. Unfortunately, we don't have any really good open interest or volume statistics coming out of the Chicago Mercantile Exchange, because nothing's really changed. The volume is still pretty much the same. The open interest is pretty much the same. So the same players are there, and so even with the big downdraft that we had in gold when it went down to the 1550, we didn't lose many players. So the game has not changed much there. It's just that there's nothing really happening to make anything really move around a lot. That's totally different than what we've got going in the U.S. dollar, because the U.S. dollar has all these patterns completing in the euro and in the yen and in the Australian dollar, and also in the British pound and several others. And so we could get one heck of a sell-off in the U.S. dollar, i.e. a rally in the euro and the pound and the yen, the yen versus the dollar, and that would be just nothing more than a short covering rally like we've had before. We've just hit some major spots, in the market as I see it. Now, I don't know if there's going to be much correlation between the silver and gold and the U.S. dollar, but I did look at the correlation before the show, and I really couldn't find anything that was, very, very important. When we looked at copper, versus stocks, you could see that correlation in the fact that it's, totally blown away, and, there's virtually zero correlation between copper and stocks now. But, what we're trying to do is to find one that if it does hook on the correlation that we can see that it's going to move. But right now, you have to look at each of them separately. They're non-correlated. I mean, the silver and the gold are not correlated to the U.S. dollar. Back years ago, when there was Forex banks and most of you folks didn't have access to this, I'll talk about a little bit about Forex when we get back from the break. 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and we were talking about Forex and how it related to the dollar. Of course, the dollar. To gold and silver, back in the 70s and 80s when we first started trading gold. Gold first started to be traded in 1972. I believe it was about $180 an ounce, as I recall. But the chart that I'm going to put into Tiger TV right now is the gold and silver on a weekly basis, the gold-silver index. It basically shows, that we hit that 61% retracement last week, and thus far it's held. We're making a little test today, I think. But if we go, if this market collapses, and I mean going below 1550 in the gold, and it's going to be something that the bulls in gold will not want to see happen because it will be terrible. But the chart that's in the Tiger TV now, it will show the gold and silver index, and then overlaid upon that will be the U.S. dollar index. I put that in red as a line chart, and you can see that there's very little correlation, between the currencies, and the gold and the silver. So you've got to trade each one of them separately. Everything that I trade, I trade separately. I try not to look at intermarket, comparisons because I'm interested in focusing on how much I have to risk at any one particular time, and so that's why I'm focusing on the fact that if I just trade the euro or the yen or the pound, I know I have control over that. If I start thinking about the interrelationships between gold and silver, and that's too much thinking, and I don't want to do a lot of thinking. I just want to do react to what I see, and that makes it, a whole lot easier, for, what I'm looking at as far as, being able to, make a really good decision on whether we're going to go up or down in any of these things. I'm just interested in how much I have to risk, not in how much, I have to try to make or anything. Okay, now we had a breakdown in the gold and, in the Treasury bonds last week, and, when we went below that 42 level. And what's happened now is we have come back and we have gone to test that level one more time. I'm going to put that into the Tiger TV and show you that, we just had another 382 retracement in the Treasury bonds, which is not a very good sign for the bonds. These things look like they want to go a whole lot lower. And so interest rates are getting ready to go higher, folks. They're not going to be going lower forever. And it looks like we've made the what we think is the biggest top. It was made probably 4 or 5 months ago at that 154 level, and then we had the test back in the notes, and we had the test back in the Treasury bonds. The notes tested to the 61% retracement, and the bonds tested to the 382 retracement. That's telling us that, at least it tells me from a technical standpoint, and the fact that the market broke really badly, that tells us that, we're looking at higher interest rates coming, very, very soon. It's not going to be, something that is going to be delayed by very much. So remember, the Fed can only do so much. They can set interest rates at zero, but they can't keep them at zero because the market is the one that really determines whether it's going to be the main thing of where interest rates are going to go. Now, I also wanted to talk a little bit today about muni bonds because we've talked about them before in the last last 3.5 weeks. The muni bonds have been breaking badly. We've been talking about the lower tops that have been occurring, and now the market is breaking down. It's leaving gaps. It's going below, the 786 retracement. So all of that tells us that, we've got higher interest rates coming. Someone asked me the question, well, how can the stock market go up if we have higher interest rates? Folks, I don't know if the people in the stock market are the same as the people in the bond market, because the bond market people, that's a market that is 6 times bigger than the stock market. That's money that is much higher capitalized than in the stock market. So there's different types of people, that are trading these things, and there's different cycles in there too. So my assumption is that the final cycle high. You remember in 2009 we made the low on the 9th, and here we are, out into the 13th, and we still haven't, we've topped in a couple of these things, but I don't know if they're all going to top at the same time. But this is not the time to be buying stocks. If you look at these patterns and these 3 drive patterns and all of these things that we're looking at, and the Gartley patterns and the NASDAQ and the New York Stock Exchange Index, and then the 3 drive pattern on the Dow Jones and stuff. It's just really a big difference. I have one particular chart that I want to share with you that one of my colleagues here sent to me this morning, and hopefully I can get it up here and pull it up. Oh dear, it won't come up now. Darn it! I guess I've lost it. But it was a really nice chart showing the 3 drive pattern that had happened. I have it. Hold on just a second. I just found it. Just nothing like old age to catch up with you. This goes back well over 15 years, and it shows the 3 drive pattern that is occurring now on a decade basis. Every time we get around that 1552 level in the S&P 500, we've had some very severe sell-offs, and this one we have a lot of patterns, coming into it. So this is not the time to be, overly bullish. The market might go higher, I know that, but I don't think it's going to go much higher. And then when it does turn, as you can see from this longer-term chart that we look at, the corrections were, very, very substantial, well over 40%, in each of the instances. But the patterns are there, so we'll see. I don't know if the interest rate picture will be the thing that is the outlier event that, that makes the market, move dramatically. But the Fed has, come in against all, reason to put money into the banks, to keep interest rates low. But the banks have not turned around and given, lower interest rates to the customers, and that's what the whole thing was supposed to do. What it did is it propped up the banks, and that's the bottom line of the too big to fail thing that's been going on. So anyway, that's what we have to live with when we're dealing with these things. So I don't know when they're going to turn, but frankly, it's just a matter of time. It just keeps grinding higher, just like it grinded lower back in 2009, and we'll see. Someone asked me to take a look at IWM, which is the small cap index. I don't follow that very often, but it's probably, yep, it is. It's making new highs again, and it continues to go up, and we're about a 1.27 expansion with gaps all over that thing. And believe me, if you just go back and look at the chart of the let me correct the ABCD here, because when I changed the data, the ABC got confused a little bit, and I wanted to make sure that you see what I'm trying to show you, where the gap is and everything. But there's no gaps on the IWM chart. You can go back as far as you want, and they will be filled. It's a question of when they will be filled, and that's it. Anyway, they keep going higher, and you can have a party and go up and ride it as long as you like, but it won't be long until the proverbial lady in the large dress sings, and then there'll be some ramifications of the things that are occurring in these markets that people don't want to look up to, because that's what will happen. Is some people are going to get hurt, and that's the mutual fund people that that buy this stuff. That's not their money, folks. They don't have any skin in the game. You got to remember that. They just keep buying because it's not their money. They just keep buying as long as it's going up. They just keep buying. It's when it starts to go down is when the problem arises. So just keep in mind that you've got to be the one that protects yourself, and that's my assumption here. Is that we are very, very close to something that is really, really sinister. Even today, with the stock market being as strong as it is, the New York Stock Exchange Index is still not making new highs, and is still on a weekly basis at a level that it is at the 786 of where it was from 2007. So, and this is the real market. I mean, this is the real market. I know someone says, I really get tired of hearing you saying that, but I'm just trying. The repetition is the mother of knowledge. But this is not a new bull market that we're seeing, and what they're telling you about the Dow Jones Industrial Average. This is not 2000. This is not 1999. It's not that type of market at all. And so we'll see how it ends up. But we're gonna, maybe it is different this time, and who knows. But we'll have to wait and see. But anyway, just be careful. I keep saying that, and I'm probably losing more friends than I want. I know I won't lose my friends, but probably lose a few customers because the market goes up and they're not participating in it. But remember, we didn't participate in Apple. We got out of Apple. They at least warned you folks around that $700 level, and I still think Apple's got a shot at the 394 level, and I believe that it's got a shot of doing that. Now we have another market that's had a pretty good run here. recently, and I wanted to bring it up. It's the crude oil market. If you'll give me 1 second here, we can bring it up here to take a look at it, because we've had a little bit of a rally coming off of the $90 per barrel level. I know this should be the commodity department, but we're doing the same thing in a lot of these commodities that I've been talking about all along: gold, copper, silver, corn, wheat. I mean, a lot of them they're just not rallying, folks. And if this were really a big bull market in stocks and everything was like Camelot, supposed to be, then these commodities would be dragged up along with it. And the Chinese market is not going up either. It's getting hammered also. The Hang Seng, I posted this several weeks ago at the 786, and it's down, well over 1,500 points in the Hang Seng, which is 5% in just a matter of a very short period of time. That hasn't happened to us here yet, but I think it will be eventually in the cards that this is what we'll be looking at. So the crude oil has had a rally of about 5 days. We stopped at a very, very short-term resistance at the 382 level, and it doesn't look like it's going to pull back a little bit into the $90 per barrel level one more time. But if we go below $89 a barrel in the oil, that's going to be a very negative effect. That's going to be very similar to what happened in the Treasury bonds when they broke the 142 level. That means these cycles are breaking early, and that is known as left translation in the cycle theory, because that means the cycle peaks early in the cycle and then it goes down for the rest of the cycle, and that's a very bearish scenario. That's what happened in 2007 in the stock market, in the bond market, and everything else. So that's what we have to, really keep in mind, is that if these things fail, then that's it. And we were watching bonds because they were telling us that they wanted to fail because they wouldn't rally very much. And so if gold doesn't rally very much, why couldn't gold get above $1,600 today? It was a perfect 61% retracement. It wouldn't have taken much buying at all to get it to 1610 or 1620, which would have been more of a breakout, and yet it could not do it. And the same thing with the silver. The silver couldn't, break above its 61% retracement. So that's giving us a situation where, we have to think that these things are not nearly as bullish as they would like for you to believe. So just keep in mind that that's it's an important thing to take into consideration. And the same thing that we're watching when we're looking at the S&P over the past you can go over the last 5 or 6 days. We've had up and down moves with very, very little volatility in the S&P E-mini 500. It's moving like everybody is asleep. It used to move 15, 20 points without any trouble. Now it has to struggle to move 5 points. Okay, we've got to take a little break here. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks. I posted into Tiger TV the FXI, which is the ETF for the Chinese market, and it shows the divergence between what's happening here and what's happening in China. And remember, that's the second largest economy in the world. And what you don't see here is the long-term FXI chart, and that goes back to 2006, making lower lows. It's been in a bear market for well over 7 years. Maybe they'll be bottoming here someday, but right now the correlation that we have here is, you certainly don't want to be looking to buy Chinese stocks. I guess if you're looking on a relative basis, they're cheaper than the U.S. stocks, but that would be the only thing to look at. Now, there's one other one that we want to put in, and that is the Nikkei Dow, because we were watching this all during 2012 when we were having the higher bottoms forming, and what we've done now is we've gone up to this 13,000 level, in the Nikkei, and it's certainly made a big Gartley pattern here, and we're at a 7.86 and 1.27 expansion ratios. It was off quite a bit last night, but not enough to, really make a much of a difference for one day anyway. We'll have to wait and see what it does over the next few days. But these patterns are forming on an international basis too in the Asian markets. So it's a time to be cautious in buying stocks. Of course, that's my opinion, of course, but we'll see if that's the case. Now, we want to remember the number of $15.50 per ounce in gold. If we get below that, there's real serious problems there. We're trading at $15.85 now, and that's the important number. If the bonds get back to the 142 level, it bases the June bonds, you want to be looking to probably, put some short sales out into that area because the bonds have turned over. Just by looking at the muni bond chart that we posted in here today, you can see that the interest rates have started to move higher in the markets. I mean, Bernanke, I know they follow these things and everything, but this is real money moving. It's not Fed money. So this is somebody is getting nervous, and we'll see what the ramifications are going to be a little bit later. Someone asked, are they putting the money into the stock market? Well, if they were doing that, the stock market would be going up 150, 200 points a day because there's 6 times or more money in the bond market than there is in the stock market. And so there's just not the same correlation that you can get. So just remember to be careful at that point. Now, tomorrow on the Commodity Show, we've got to get ready because we've got the Planning Intentions report coming out on the 28th of the month. And that's the end of the show, folks. Live every day in an attitude of gratitude, and may God bless.